Hello and welcome to Trade Plates TV Live. I'm Rebecca Chaplin and I'm joined today by the Managing Director of Lookers PLC, Nigel McMinn, and next to him on the sofa is James Baggott. We are going to be doing the same thing as usual, chatting about what's going on with these guys at the moment, but also we really want to hear your questions. So if you want to get involved, just look below the screen now, type your name in, let us know that you're watching and send over any questions, or if you want to talk about any particular topics, just let us know. Otherwise, you can tweet us at Trade Plates TV or get on the website for next week and we'll be picking up more of your comments from there. So we're going to start with Nigel, straight in with the grilling questions. What do you think is the future for the new car market? Because it's been growing and growing. Do you think it's going to peter out, or is this just rolling on?
Well, lots of people do. It's something that we constantly find ourselves talking about. That I think we're all so scarred in this industry from 2008, when we had the big recession. The big crash in registrations for the next kind of 5 years. I think we're all sort of waiting for that to happen round the corner. And we've been quite bullish about it for some time, and to the point where actually I occasionally get ridiculed by some of my peers and friends in the industry. But Andy Bruce and I have compiled quite a bit of evidence when you look back over the long term that says that actually there's quite a lot of compelling economic information that says it will continue to grow. So we looked back over 60 years. We tend to only look back over 15 years. But when you look back over blocks of 15 years, going all the way back into the late 50s, you'll see that there's a fairly familiar pattern that's followed in each 15 years. So it seems to have some kind of dip economically, and then the registrations go on quite a long run, 10, 12 years of recovery, where the pent-up demand feeds back in. And that's repeated each set of 15 years,
right.
As the economy falls into recession. People talk about it having its own cyclicality, this sector, but in our view, the evidence says it follows the cyclicality of the economy. And what you see over that long term is that registrations tend to grow in line with population growth and GDP. So the norm for the 15-year block from say sort of 1960 to 75 was actually less than 1 million, the average across that 15-year period. The next 15 years it jumps to just under 1.5 million, the next 15 years to just under 2 million, taking us to about 2000. And of course the period that we all tend to talk about from 2000 to 2015 is an average of about 2.45 million, just under 2.5 million. So it seems pretty logical to us, given that it's jumped every 15 years, the norm has jumped by about 500,000, that the next 15 years up to 2030 will probably average out at somewhere around 2.9 million. And inevitably, to get an average of 2.9 million, we think that at some point in that period it will go well past 3 million.
Wow.
And it's interesting that quite a lot of people who thought we were being far too bullish are now saying that it's feasible that it could hit 3 million in the next 2 years. We're saying it could hit it in the next 5.
What do you think we'll do this year then? What's your prediction?
Well, if it grows 5%, it'll take us to about 2.85 million, and then a further 5 or 6% would see us past 3 million. And all the indicators of, we're 6.3, 6.4% up after the first quarter, most of that driven by private registration growth. It's highly likely it could do 5% this year. There's a little bit of a pause, like we saw around the time of the general election in the UK. There seems to be a bit of a pause leading up to the whole Brexit referendum. But our view is it will probably speed up again once we get through that.
Do you think that's because private buyers are holding off because of the uncertainty? I mean, how's Brexit affecting your business?
Well, I think as soon as you inject any level of uncertainty into the economy, consumers tend to sort of sit back a bit. So you've seen what's happened with share prices, including our own, and not just our sector, but all share prices have come off quite significantly. So anybody with savings or investments is going to get exposed to that. And I think you just see a bit of a pause. People just sit back a bit and say, well, let's just see what happens in case something's affected. We saw a little bit of the same when the Scottish referendum was on. Up there for 2 or 3 months prior to the referendum, things just slowed down a little bit. I'm quite confident. Last year in May, up to May, there was no registration growth privately, but we finished with kind of 5%. All was backloaded after the election.
So with Brexit in the conversation, I mean, where do you think it's going to go? And for your business, what would be the worst case scenario?
I mean, I'm guessing like everybody else, and so this is more of a personal view than a corporate one. I think our preference is to retain some certainty. When you get that level of uncertainty, then people can do erratic things. But I mean, I think it would be better for our economy to stay part of Europe. From what I hear, it would take a long time to negotiate the trade agreements, not just within Europe, but all throughout the rest of the world that would have to replace the European agreements. And that could be quite a lengthy and difficult process. We still haven't, negotiated the one with the US. So that could cause some disturbance in the UK. So I think our preference is to stick to the economics of it and say, we're better in than out.
So what's working well for you? Obviously, you've just had your 7th successive year of growth, which is definitely something to shout about. What do you credit that to?
I mean, it's actually longer than that. 7 successive years of record growth since that sort of hiatus in 2008. But actually, we've had 15.3% compound annual growth across 15 years. So it's quite a resilient sector. A lot of people talk about all the difficulties and the challenges, but whatever gets thrown at us, we seem as an industry able to rebound from it quite quickly and grow again. And I think in our case, certainly in the last 7 years, part of that has been due to the recovering new car market and the consequent impact on used cars and after sales. But I think a big part of it is the fact that we have carefully changed the shape of our franchise portfolio much more towards the premium brands.
Right.
I think a big part of it is the devolved nature of our company means that we tend to attract and retain good quality managers who we allow to manage, and good people like to actually add value, play a part, make decisions. And I think a good part of it is down to the very senior leadership. I think Peter Jones was an excellent chief executive and set the business on a very strong growth curve. Andy Bruce has followed that on, and I think that's a really key part of it. So carefully selected acquisitions, pruning of the portfolio in some places, and good strong management.
Why have you tried to move towards the premium end?
Well, a couple of reasons. So one is if you look at the combined market share of Audi, BMW, Mercedes, JLR across a long period, 15, 20 years, that collection of franchises have always grown in market share. So it's obvious that in the UK we're quite an aspirational, brand-orientated society that wants to have the right badge on the car, and that doesn't look like it's going to slow down. They've obviously developed much bigger, broader model ranges, pushed into the lower price points, and that's enabled people to get access to those brands as new cars. You've got the whole PCP wave that's allowed affordability of those premium brands. So I think we just buy into the whole growth story of premium brands in the UK. From a more sort of commercial, financial point of view, if you look at the amount of registrations throughput per site, the premium brands tend to dominate that.
Right.
So they keep their network size quite manageable, circa 120 dealerships. And then they push a lot of volume through a relatively small number of sites. Most of the volume brands would have twice those number of outlets. When you overlay that with the fact that their new car profit per unit is, let's say broadly double what a volume brand will be, it's easy to see why the profit per site ends up being significantly higher. And that's one of our key metrics. We're constantly looking at what our average profit per site is.
So I was going to say, so who's really performing for you in terms of brands at the moment?
Well, I mean, all of those premium brands do extremely well. So Land Rover does extremely well. They're our most profitable per site. Mercedes-Benz are actually now our second most profitable per site, just behind Land Rover. And then Audi, still very strong as well. But on the volume side, Ford per site, certainly per market area, is a very strong performer for us as well.
And I'm interested in Jaguar as well. I mean, Land Rover obviously doing extremely well. I mean, Jaguar performing as well. I mean, especially with the new F-Pace coming into dealers at the moment. I mean, we've been told that that's sold out and performing fantastically. Are you seeing that at the same time?
It is, yeah. No, I mean, we're struggling actually to have the right level of resource to cope with the demand just on F-Pace. Obviously, the inquiry levels ticked up quite significantly when XE came. So there's no doubt that franchise is on the march. It's been very much the weaker cousin of Land Rover, of course. That's had all the limelight and the success, but there's no doubt Jaguar is going to do much better this year.
And how's F-Type doing? Is it still as strong? And we had one in for a road test a couple of weeks back, and I felt it starting to look a little bit dated, which seems to be quite quick in that cycle. I mean, is it selling, or is it still as popular as it was when it first came out?
Yeah, well, you're the first person I've ever heard say that.
Really?
Yeah, I don't think it looks dated at all. I think it's a stunning looking car.
I don't doubt it's a beautiful car. It's just I think we've seen it for such a long period of time. It's kind of, it feels like it's got old in my eyes.
And it's a niche seller, James. So I mean, it's never going to sell in huge numbers.
Yeah.
And inevitably, these things can be a bit flavour of the year, the hot car that year. And it's no doubt it's past that, but it's still selling well in the numbers that we would expect it to. Yeah.
Well, that's good to know.
We've had a question from Simon Shield who says, how much of the increase in registrations is due to PCP growth and pre-registration?
Well, the level of pre-registration, I mean, again, this is a bit of an urban myth. I mean, there's no doubt the market gets forced, right? So nobody's denying that. But a forced market with some level of self-registration has always been the case. Even in the years where demand was much stronger than we all expected, there was some level of self-registration. I can only speak about our own experience that it's no greater this year or last year than it was in previous years. And we always talk about good pre-reg and bad pre-reg. Good pre-reg is a massive opportunity. If you can do that in a position where targets have already been hit, and it's taking you to another banding, or there's a specific incentive on to do some more, that's great for us. We're not in a position we have to do it. The problem is when there is too much bad pre-reg and you're having to close the gap to a very demanding target by taxing up an amount of cars that you wouldn't choose to have in stock. But we don't see that at any greater level, certainly not across the piece. I mean, we're talking about 31 different brands here. But we measure the total amount of private registrations each month and the amount of self-registrations within that, and it runs sub 10% pretty consistently for us. We did have a couple of quarter ends last year where it floated into the high double digits, but so most of the time it's under 10.
By that you mean 10% of it is pre-registrations?
Under 10% of the total private registrations.
Right, okay. Yeah, so do you in your business see it as a bad thing or a good thing or a necessity? I mean, what happens if all of a sudden you took pre-regis out of the market completely? Would that be a problem for you?
Yeah, that'd be a problem for us, yeah. It's because the new car retail market is heavily driven by PCP offers. I mean, to the point where if you look at our website and many others now, you'll hardly see adverts for cars with a big cash saving. You see them with a deposit contribution and an attractive monthly payment, often with some sort of additional incentive like free servicing or free insurance or something. So actually, a heavily discounted, nearly new or delivery mileage car is actually really attractive because it gives us another angle for those people who aren't payment orientated. But 80% of our new cars last year were sold on PCP. So, to have a price offering as well is a good thing.
Yeah, so there are still people who come out there with cash in the bank and want to pay for it with a bank loan, for example.
Of course, yeah. Yeah,
they don't want to take your finance.
There is a nearly new market that prefer the cash price.
So with that question in mind, is PCP, it's obviously a massive part of your business now. I mean, that seems to have just exploded in recent years. Do you think that's going to continue and we're going to get to the point where it's 90% of cars sold in PCP?
It's got to reach some sort of saturation level, you would think. I mean, I'd be guessing, but it could go into the mid-80s. I can't see it getting much past 90. I think there's always going to be a portion of the market that doesn't do PCP. You know, there are legitimately lots of customers who have the cash and just don't want a finance agreement.
Has that affected your used car business at all? I mean, are people coming in and going, oh, I want this used car, but actually I can get this brand new Volkswagen Golf from PCP for less or for a more affordable payment?
Yeah, it has a little bit, but what we're finding is there's just a greater separation between the new car retail demand and the genuine used car demand. The lines, when it was all cash driven and it was all cash discounts, the lines got very blurred between new, pre-reg, ex-demo and genuine used cars. Whereas now they're more distinct. You do get a nearly new market, but it's generally a lot thinner than it was 20 years ago. You know, I was brought up at Reg Vardy's, you know, and our focus on that nearly new market was pretty extreme. I mean, it was almost the same, in our view, it was almost the same sort of focus that we would give to that as we would give to used or new. And it certainly isn't that now. It's part of the tactical marketing. So, you know, I think it's a really important part of the market. Does it detract from nearly new? It did a bit, in truth, and the manufacturers started to introduce PCP on used cars up to a year old. Now, pretty much, most brands are offering PCP as long as the car is no more than 7 years old at the end of the contract. So you can put 3 or 4 year cars, 3 or 4 year old cars onto PCP. We did some stats actually for our city presentations that showed that 37% of our used car finance is now PCP.
And is that growing?
It's growing, yeah, it's growing very rapidly. It was 5 years ago, it was 5%.
Right.
So it is growing very rapidly. And interestingly, if you go back 7 years, the proportion of new car finance that was PCP was only about 45-50%. You know, so it's grown very rapidly to the levels it's at now.
Is that because people are more used to a monthly payment? I mean, they pay for their phone on a monthly payment over 2 years. Is it consumers' opinions of finance changed? I'm trying to understand what's actually driven that PCP demand. Or is it the fact that it's just marketed so well?
I think it's both those things. So partly, we live in a society now where most consumers pay monthly for their gym membership, monthly for their golf club, monthly for their TV subscription, monthly for their insurance. Everything is monthly. So I think it's easier for people to budget monthly. So there's no doubt the appetite's there for it in the first place. But a big part of it is the supply push. I mean, most of the tactical offers now are put through the PCPs. So if you're getting a £5,000 deposit contribution on a PCP, you won't necessarily get a £5,000 discount for cash off the same car. So you've got consumers that are open to it, but you've got the market being pushed that way.
Right.
Okay, we are going to cut to a very quick break. After the break, I'm going to be joined by Stephanie Ball, who is a legal advisor at Logistics, and she is going to be talking about the new pension scheme. So if you've got any questions about that, I know a lot of you do, send them over now and we're going to ask them to Stephanie just after the break. We'll be back in about 3 minutes. Thank you, bye.
At this year's CDX 16, car dealers can expect an action-packed day. We've managed to line up some fantastic keynote speakers. People like Facebook and Twitter are going to be there to explain to dealers how to use social media to the best possible way when it comes to selling cars. We've got Google, who are going to explain how the search engine can work best for dealers. We're also delighted to say that we've got Jim Holder. He's the editorial director from Haymarket, behind brands like What Car, Autocar and Piston Heads, and he's going to be giving some fantastic insight into what car buyers want these days.
Some of the key workshops of CDX 16 will be covering topics such as personnel, training and development, how to find the right talent, how to retain that talent, and how to look at things like your website, marketing, and of course the all-important how to increase sales.
Suppliers really need to be at CDX. It has rapidly become the event for the motor trade. Last year we had 1,500 dealers turn up. This year we're aiming for 2,000.
All of our workshops are hosted by experts in their field. So you're going to come away and you're going to have learnt something from those workshops that you can implement and put into place in your business the very next day.
This year for CDX16, we're not resting on our laurels, we are making it bigger and better than ever before. And that's not only the expo is going to be larger, we've got an additional hall, but we're also going to be focusing more on the workshops. The workshops are where dealers can learn something new. We've got 12 fantastic topics. They range from recruitment to personnel to making the most out of online sales. And it's the place where dealers can really pick up some hints and tips to better their business and make that day out of the office really pay for itself. So if they haven't got a place at this year's CDX, they need to hurry up because places are selling out very, very quickly indeed. It's very easy to get more information about CDX16. They can simply click on a link that's probably going to be playing underneath my face. They can call the office on 02392 522 434 or tweet us. I'm at Car Dealer Ed, the magazine's at Car Dealer Mag. We're out there, we're listening to what you've got to say, and if you need any help in booking a place or booking a ticket, then get in touch with myself or any one of the team here.
Hi, welcome back to Trade Plates TV Live. On the sofa with me today, I've got Nigel McMinn from Lookers and also James Baggett next to him. But you'll notice on the screen behind me now, we've got Stephanie Ball, who is the legal advisor from Logistics. She's going to be talking to us about pensions today. So we'll just kick off, Stephanie. Who is eligible for these new pensions? Can you give us a little bit of background of what the situation is?
Yeah, so the new workplace pension auto-enrolment scheme has kind of been introduced since 2012. It applies to all employers, so even those employers who are employing even just one employee, it could include that one employee. So pretty much any employer needs to be aware of these kind of new auto-enrolment rules. So, but not all employees will be eligible for auto-enrolment. So the employees who are eligible for auto-enrolment, there's three criteria. Those who are aged between 22 and state pension age, those who are earning more than £10,000 a year, which roughly equates to about £833 a month or £192 a week, and those who are working in the UK. So if you have any employees who are who fit into all of those three categories, then they must be automatically enrolled into your workplace pension.
So sorry, did you say they have to be eligible for all of those things or just one?
Yes, all of those things.
Right,
yes.
okay.
So if they're 25 but they're not earning £10,000 a year, that would mean they're not eligible to be automatically enrolled. They might still be included in your workplace pension, but they're not going to fit into the auto enrolment rules. So
if someone's already got a pension set up for their employees, they don't need to worry about this.
Yeah, so if so quite a lot of employers might already have a workplace pension scheme in place. If you do, that's great, that's fantastic. There's probably not a lot else you need to do to get set up to be compliant with the auto-enrolment rules. But now that these auto-enrolment rules are in place, it's a different date for every employer, which I'll talk about briefly in a moment. But if you haven't checked that all your eligible employees are auto-enrolled into your workplace pension scheme, and that's basically you just need to be checking that all of the eligible employees are automatically enrolled. So yeah, if you don't have a workplace pension scheme in place, which quite a lot of small businesses won't, they might not already have a workplace pension scheme. So if you don't already have one in place, then you will have been sent, all employers will have a staging date sent to them by the pensions regulator, right, which tells you when you have to have a workplace pension scheme or auto-enrolment rule set up by. So all employers, by their staging date, must have this in place. So that's the kind of things that employers need to be checking that they have been sent their staging date and they've kind of got everything up and running, ready in time for the staging date.
What sort of things are they going to need to get prepared? Is there anything they need to be aware of?
Yeah, so obviously the first thing to do is, before the staging date, is choose a pension provider if you don't already have one in place. So generally, for example, logistics, we wouldn't give advice on which pension provider to use. It's really down to each employer to find a pension provider that suits them, suits their business, suits their employees. There's lots of advice available on the pensions regulator website, you can all get some financial advice as well about what pension provider you think is suitable for your business. So once you've chosen a pension provider, that's fantastic. You've kind of got that all set up and running. You then need to decide by your staging date. You need to work out who should be automatically enrolled, which one of your employees. So that's when you need to look at those 3 criteria and work out which employees need to be automatically enrolled. And then by the staging date, you need to let the employees know who's going to be automatically enrolled, and then they will be sent letters by the pension provider letting them know that.
At that point, can an employee say that they want to opt out of the scheme?
Yes, so employees can opt out.
Right.
To opt out, they have to be automatically enrolled if they are eligible, and then if they want to opt out, they let the pension provider or the employer know. Each pension scheme will be slightly different, so if they want to opt out, if they don't feel that it's right for them, they can opt out, and each pension provider will have a different way of doing that.
Right, okay. So what is going to happen if a company doesn't comply to these new rules?
So the pensions regulator is in charge of compliance, so they'll be making sure that all employees are compliant. The aim is to really make sure, obviously, every employer is compliant. So they won't start putting fines in straight away, but they will be kind of issuing advice if they find out that employers aren't or don't have the right schemes in place. So they will be checking, that they are. They'll be issuing kind of notices to let people know that they're not compliant, and giving employers, they should give employers chances to kind of get up to date. But if not, and employers ignore that advice, and they can be fines issued. £400 is a starting fine, but then obviously that can increase if employers choose to ignore the advice and choose to ignore the fine and still don't comply. The fines can be pretty big. They can be £50 to £10,000 a day fine. So it's pretty important that it's pretty important that employers do make sure they've got everything in place and are doing the right thing.
So for anyone that's looking into this now, what would be the advice that you'd give them to get on top of everything?
Yeah, so if you don't, this can be quite scary to some employers who don't have anything in place. If this is completely new, they don't have any kind of workplace pension in place. This can be pretty scary to some employers. So, take advice, start looking for the right pension provider. Definitely, have a look on the pensions regulator website. There's quite a lot of information on there. Just kind of get everything into place, really. Have a look at, which employees of yours will need to be enrolled, because it's probably quite a large percentage of your employees will have to be enrolled. Obviously start, potentially, looking at budgets and things like that, because the contributions that employers have to make can be quite big as well. So, employers might need to start looking at, affordability and things like that. So
that's actually a question we've had on here, saying what's the anticipated impact of costs on businesses? Probably something for you as well, Nigel. Are there going to be job loss implications? I mean, how big could this be for small businesses particularly?
Yeah, so the contributions that employers have to make, so employers have to make 1% as a minimum. They now have to make 1% contribution of qualifying earnings. So for however much your employees are earning, 1% of the qualifying earnings will be contributed. The employee contributes 0.8% of that, and the government contributes 0.2% of that, and that's by way of tax relief. So, 1%. Per employee, so it could be pretty big if you have a lot of employees.
But really, this isn't something people should worry about. They just need to get everything straightened out, I guess. Take some advice from you.
Yeah, something to think about. Yeah, and kind of start planning really. You know, it should be a fairly simple process to get everything set up and running. And you know, if you do need advice, and there's plenty of people out there to help. Pensions regulator, you know, get some advice, legal advice as well, and just make sure everything's kind of set up and in place really. But yeah, I guess you know, planning, you know, business, you know, planning your finances is could be quite an important consideration.
Perfect, that's great. I don't know if you guys have got any questions for Stephanie.
Yeah, well, one question that springs to mind is roughly how many dealerships do you think are going to be affected? I mean, generally, do smaller, say, second-hand dealerships have pensions set up for their staff? Is this going to impact the industry quite a lot?
I think our experience so far has been quite a lot of our clients haven't had anything set up. So quite a large percentage of them are in those employers who are starting from scratch. So they have had to go out, find a pension provider, you know, get themselves, you know, compliant by their staging dates. And it can be, you know, quite a scary thing if you haven't had to do that kind of stuff before. So, but yeah, I'd say it's pretty big news really for all businesses, not just the motor trade, but for all businesses. You know, it's pretty you know, it's pretty big change actually to how, you know, to employees.
Definitely. Anything else? No? Okay, I think we're going to wave goodbye to you now, Stephanie. Thank you so much. That was really great.
Thank you.
Cheers. Thank you. Bye.
Bye.
So, you've obviously had to deal with this, have you? Or did you have pensions in place before? Or?
Well, we've obviously had pensions in place for a long time. And the bigger companies had to go first with this stuff. So auto-enrolment came to companies in order of size. So we've been on it for some time now, and are actually starting to already forecast the impact of having to go to 2%. It's starting to escalate beyond the 1%. Not all employees want to do it, of course, because it does mean some contribution on their part.
I know this has been something in like the coffee shop industry, that people aren't getting their free sandwiches anymore because of the pensions being added in.
So I mean, I'll come on to the impact, you know, commercially on the profits of our companies of doing this. So I think we all understand it's the right thing that people start saving. I question whether or not 1% creates any kind of meaningful pension pot for the level of administration that's involved, and of course the cost. But it's here, and it's one of many areas where government intervention through compliance or regulation or taxation is a burden on the business, and you know, there's no point in fighting things that you can't do anything about. So there is no doubt that it's a cost on the business, tangible cost, and there is a cost in time and administration. The great thing about our businesses is that there are a whole load of moving parts, and in truth, when you look really carefully at your business, there are lots of, you mentioned it, you know, perks and incentives that we take for granted. There are more tangible commission and bonus schemes that of course are part of people's packages, and the other thing is productivity. You know, in truth, we measure productivity reasonably well. We don't tend to actually manage it anywhere near as tightly as we should do. Even in after sales, we don't really tend to look at productivity measures too hard in sales, in administration, in call centre type activities. And I think across the whole spectrum of perks, benefits, commissions, bonuses, and productivity, there is lots of scope for us to mitigate the cost of these things, but we just have to work a bit harder around them.
So your big news last year was acquiring Benfield. How has that been for you? Because 6 months in now, a bit longer?
Well, great for me. I've got an office back in Newcastle. So no, it was big news, and it was one of those rare acquisitions where it hadn't leaked you know, too much around the industry. Of course, there are always a few people who post-rationalise and say, "Oh, well, I knew all about it." But I think on this one, it was kept pretty quiet. It's been brilliant. I mean, I've been in this industry 20 years and involved, particularly with Vardy, with a lot of acquisitions, and this is the smoothest acquisition of any size that I've ever been involved with. And I think part of that is because there's just a really good cultural fit between the two businesses. You know, the people who work in Benfield are very like the people who work in Lookers. And I think obviously my personal connection with both businesses plays a part in it. But I think more than that, we've put a lot of effort in to make sure that Benfield are playing a significant part. You know, a number of their people have taken national jobs in strengthening our head office. Some of them have been appointed to the board. And we've taken 3 or 4 of their key systems that we were going to roll out something similar across Lookers, and we've used the Benfield systems. So I think that they can see that they're playing a more active role in the group. It's not just a steamroller that's turned up and, you know, made them all into Lookers dealerships. You know, I think they realise that they have a big part to play in the group. So, you know, like any acquisition, if you make them feel valued, then it's more likely to be a success.
What was the most attractive thing about Benfield, apart from having an office in Newcastle?
It's an expensive office. The most attractive thing about it probably was the geographical representation of the franchises, because Lookers, other than the 3 dealerships in Teesside, didn't have any representation in the North East or really anything in West Yorkshire. We had some Ford dealerships in Sheffield. So if you like, it clicked together a piece on the jigsaw, which was really, you know, just straightforward and obvious. So the 3 dealerships we had in Teesside were Volkswagen. Benfield brought a whole load of Volkswagen across Tyneside and Northumberland, right the way across to Carlisle. We had Ford in Sheffield, they had Ford in Leeds. That's given us now quite a big presence of Ford in Yorkshire. We have quite a lot of Renault and Nissan in the northwest. This now gives it us in the northeast. So it's from a sort of geographical and a management structure perspective. You know, it's just a very natural fit aside from the culture.
How many dealerships are you up to now, including those?
160.
160. So have you got any aspirations to grow even further?
Of course, yes. World domination, James.
So where would you look to expand into next? Is there a geographical area that you are underrepresented in?
No, I mean, I'm kidding, obviously. I know everybody says it, but scale for scale's sake is not our driving force. That's not an ambition. It just so happens it takes us into a club of 3 this year, probably ourselves, Sytner and Pendragon, who will all be in excess of 4 billion turnover.
Wow.
But that genuinely is just a byproduct of us growing the underlying earnings, the profits. We would like to have more of the same, really. You know, we're happy with the brand partners that we've got. With some of those, we've got quite a lot, so perhaps Land Rover and Audi wouldn't be so keen on us having too much more. But we would love to have BMW. You know, that's an obvious gap in the portfolio. It's a brand that we massively admire and respect, and we'd love to build a division around that as one of 7 or 8 key brand partners. And that's really the nucleus of our business now. You know, we are concentrating on 7 or 8 key brand partnerships.
Do you have any BMW at the moment?
No.
None at all. Okay, so yeah, that is obviously a gap.
I find that unbelievable, because you've got 31 brands, maybe so.
Well, we've got 31 brands, but an awful lot of those are in Northern Ireland in Charleshurst as part of this big 30-acre multi-dealership complex with its own road network. You know, a truly sort of unique thing over in Northern Ireland. And they trade as Charleshurst, and so although we class it as another division, in reality, of course, it's his own company under the Lookers umbrella. In the rest of the UK, Scotland, England and Wales, really the business is centred around 3 premium brand partnerships, Mercedes-Benz, Jaguar Land Rover and Audi, and then around 4 key volume manufacturers, Ford, Vauxhall, Volkswagen and Renault Nissan. Right. That's really the core of our business now.
Are there any other brands apart from BMW that you're looking to get on? Or
a lot of them are very tight and difficult to get into. We'd love to have Porsche, but I mean, again, you know, it's a very tight network. And I think we recognise that we do best when we have depth in a relationship, we have scale in the number of dealerships, because if you can build it into a company in its own right, I mean, our Audi division or our JLR division would be in the top 20 motor groups in their own right. And when you've got that sort of scale, you can put an MD caliber guy running it, you can have a dedicated brand aligned call centre and marketing team and HR and so on. So you build a business in its own right, and the lack of scale can lead to complexity, because you have to then slot that into somebody else's division, which doesn't really work for anybody.
Yeah. How is it managing all those different franchises when you've got such different businesses, I guess, all under one umbrella? How does that work?
Well, the devolved structure, you know, and treating them as an individual company is right at the heart of that.
Right.
So we're not trying to have a one-size-fits-all mentality at Lookers. You know, we respect that how Ford run is very different to how Audi or JLR will run. So we don't seek to try and make things common across the board. And I think that allows them to breathe. It allows them to build some scale in each of those divisions. But there's some element of portfolio effect. I mean, you can't expect everybody to be a winner all the time.
Yeah.
So when some hit more challenging times, then others pick up the slack. And, you know, the results would seem to suggest it works okay.
I was going to say, yeah.
You've obviously got quite an interesting portfolio there when it comes to choosing a company car. So what are you driving around at the moment?
You're not allowed to ask me things like that. So I always used to drive Audi. I had A7s, S7s. And the day I had my first Range Rover Sport on the Ecos scheme, Andy Bruce said to me, "Mind, once you've had one, you'll never come out of it." And he was right. They're just fabulous cars to live with. I've just got the new SVR.
Oh wow!
The supercharged 5-litre petrol, which is ridiculous, but I've been waiting 6 months for it to go, and I'm not letting it go now. It's fabulous. The noise it makes is
very
unreal.
nice.
Wow. We had another question from Auto123, who says, where do you see the major changes and challenges for the automotive retail industry over the next 5 to 10 years? This is a nice broad one.
That's a nice question, isn't it? Okay, so I think technology is right at the heart of this for me. So there's no doubt that we're going to see a greater proportion of customers expecting not just to do research online, but to be able to do part of the process, if not ultimately the full purchase online. So I think in the next 5 years, across the period that we're talking about, that is going to become a reality. Customers will expect also that is omni-channel. Sorry, it's an awful sort of buzzword, but it's the best way to describe it. So like John Lewis, they'll expect that they can do part of the process at home, finish it off in store, amend it in store, go back home, choose whether they have it delivered to home and the part exchange taken away, or take delivery in the dealership itself. And they'll expect us to record all of those conversations and not start from scratch at any point. If they choose live chat or a call centre, they'll expect the agent in the call centre to have that information there, know what car they've configured, what finance options they've been looking at, and they won't expect to start from scratch. And the reality is, to achieve all of that takes quite a lot of sophisticated technology around single customer view databases, intelligent online websites that read customers' behaviour, store their search information, and can connect all of those offline systems. So I think there's no doubt technology is going to play a hugely important part in it. We talked about some of it, the regulation and the compliance issues. I mean, there's no doubt the FCA are a much more forceful agency than the FSA were. So I think increasingly proper compliance will be a big challenge. Not just tick box. I mean, it's all covered by principles that you can't get around it through the sort of loopholes in the wording. And then probably the other big challenge is culture. You know, is a genuine culture of engagement and customer focus. You know, I think authenticity is the key to this these days. People can find out through Glassdoor whether you're a good company to work for. They'll find out through Google and, you know, Judge Service, Review, many other ways to find out independently whether you're a good organisation to shop with. So I think, you know, if you're authentically trying to create a good place to work and a good place for customers to shop, that will come across. If you're faking it, then I think life's going to get hard.
From what you've said, I think I know what your answer is going to be to this, but you're saying technology is going to be a big challenge. Do you think it's ever going to move away from the traditional dealership where people will just do all their shopping online and expect their cars delivered to their house? Or you've obviously invested a lot in your dealerships.
Yeah, I mean, that'd be a problem if I said yes. Yeah. So I genuinely believe that that on anything that's a significant purchase, and interestingly, I was talking to somebody from Lloyds Bank recently, their head of digital, who said that even on a mortgage application, customers want to get in front of somebody face to face, even though it's just by that point a financial transaction. We're not talking about looking around the house. they want to go and see somebody to finalise the completion of a mortgage application, because it's so significant and it's such a big commitment in spend. And of course, in our case, we've got the actual physical car as well as the finance agreement, quite often in a number of insurance products. So there are loads of reasons why the customer is going to likely want some sort of physical intervention at some point. And we're already seeing a trend over the last 5 years where there's less dealerships, but they're bigger. They're brand experience centres. So I think our view is you'll just see a continuation of that trend. Gone are the days really where a 2 or 3 car showroom is likely to hold any kind of appeal for a customer. They expect to come to an Audi centre with 17 new cars in the showroom and 120 used cars outside and a full fleet of demonstrators, virtual reality goggles, 3D configuration screens. It's a brand centre, and you can afford to have less of those, but there's more of a compelling reason to visit. So I don't think they'll disappear completely. I just think we'll see less and less of them.
Right, okay. And obviously there's quite a lot of investment in something like that with virtual reality and all this sort of thing. Do you think it's worth it, I guess? You must see a return, because obviously your Battersea store is huge and you must see people buy more cars off the back of it.
Yeah, well, Battersea is a bit of an unusual one, to be fair. I mean, that's sold to a property developer who's building 12 stories of flats above it. So there aren't many acres of land that are worth what that one's worth. But yeah, of course, there has to be a return. I mean, people talk about this as a narrow margin industry because we obsess, and in my view, over-focus on the return on sales. And that, there's so many different things feed into that. Ultimately, all that matters is return on investment, return on capital. And we have been in excess, in excess of 20%, closer to 25% return on capital for several years now. Well, that's actually not that narrow margin. And that's the basis on which we do the investments in the property. So if it's a property like the one I've described, it could cost £10 million or more. But our expectation is that it will make 1.5, 2 million pounds worth of profit for the group one way or another. So at that level, it's a sensible return on investment.
Yeah. We've got another.
Well, I was just going to ask, you're coming along to CDX, which we're delighted you're going to be doing so. Are you looking forward to the event?
I am. Well, I'm looking forward to paying you back, James, after letting you down at the last minute last year. But no, it's a very big event. I mean, I think we're talking about 1,500 people signed up already. 1,000 people signed up in the last week. Last year. So it's highly likely there's going to be in excess of 2,000 people. And we've talked about it before. I've been to NADA a few times, and increasingly I find that the UK is more sophisticated than the States, and actually we have a lot that we could share with them that they would learn from. So I think to have some sort of equivalent event to NADA in the UK is a really sensible thing to do.
So we've had another question. Very popular today, Nigel.
Today?
Yeah, sorry. Do you think there'll be changes in how new salespeople are recruited? Is there a different breed of salesperson on the horizon?
Yeah, that's already taking place. And from other peers that I talk to in the industry, they're doing the same thing. So more than half of our new recruits now into sales are completely fresh to the industry. And that's a percentage which has been growing over time. So I think, in the next 5 years, it's highly likely that 2/3, 3/4 of the people we recruit will be new to the industry. Of our top 10 salespeople in March, it's something like 6 or 7 of the top 10 have come through our trainee program. So these are guys that have only been in the industry for a couple of years and are outselling the people who've got the benefit of a load of repeat business. So I think that the new breed of salespeople who help customers to buy recognise that they've done a whole load of research already and they're down to a short list and help fill in the gaps on the customer's agenda rather than try and push the dealer's agenda. I think that's the future, there's no doubt about it. And a lot of the guys who've been in the industry do that as well, by the way. We have a guy called George Milson in one of our Scottish dealerships who does fantastically well, sells over 400 Audis a year, and does it absolutely the best way, and he's brilliant. Equally, we have another guy in one of our Newcastle Volkswagen dealerships who in his second full year of selling cars straight off the trainee programme, sold over 400 new Volkswagens last year in the year with the emissions crisis.
Wow.
So, you know, these guys get up to speed very quickly because the customers trust them and they're there to help the customers.
So are they more kind of product geniuses, a bit like the kind of Apple kind of the way of selling products, or rather than actual salesmen, they're more people there just to advise and then take payment?
I don't think that's actually, that would dumb down the skill that they've got. They're not just product experts, there is still selling involved. So the guy I'm talking about at Silverlink, Volkswagen, he just has a very empathetic way of selling. And he's not pushing the customer, he's happy to go with the customer's agenda. But there's still selling involved, there's no doubt about it. It's just not it's not the processed, controlled, Pendle style of, you know, sequential selling that we've been used to in this industry.
Yeah.
You know, it's much more flexible than that. But there's no doubt there's still selling involved.
So what makes a good salesman in your eyes? Well, when you're looking for these new guys, what skills do they need to have?
So definitely empathy is at the heart of it. The sort of trustworthiness and customer focus, the fact that they want to do the right thing by customers. This lad that I keep referring to, he says from the word go, he just looks at the people across the table from him and thinks, what if they were my parents? And I think that's a really important part of it. The other part is just plain old hard work. You know, the guys that do the best are really well organised. You know, they get all of their paperwork done and they work hard. You know, they don't like being idle. They don't like chatting. They thrive on being busy and going from one thing to another. So empathy, customer focus, hard work.
So I think this kind of does happen in the industry already, but Darren Williams has asked, do you ever see the automotive industry tracking purchasing behaviours in the same way as, say, Tesco's do, to offer what people require rather than what they necessarily think that we think they require?
Oh, I think we're already doing that to some extent. If you look in the used car market, you know, iControl essentially does that now. That's the Auto Trader product that looks at the desirability of cars by looking at the amount of searches on the internet, or through Auto Trader specifically, for that particular make, model, derivative. And then looks at it within a geographical area to say how desirable is it in your area. And that's the first, for me, that's the first part of what Darren's asking about, which is we're starting to make decisions on what we should stock based on what we know the demand is for these products out there.
Right.
Of course, it then moves into pricing, but I can see a day where we may have more dynamic pricing, the way that airlines or hotel rooms work, where, you know, within the next 10 years, you would vary the price of a car depending on how much demand was coming through the internet and what we knew was the supply of those vehicles. And that you could literally change that pricing daily. It's not inconceivable that could happen.
Someone else has asked, how do you see online companies such as CarWow affecting the traditional franchise model?
Yeah, it's an interesting one, CarWow, because I mean, they, I think, have worked really hard to try and create a business model that is not about a race to the bottom, you know, the traditional broker model that we all detest. Because, you know, broker models are really unfair, because and we supply them so as an industry, so we feed it. But these guys have no overheads comparatively to what we've talked about, and can pump out cars, you know, but purely based on price. And the whole point of retail, the whole point of the dealership is that we're supposed to build value in the products that we sell. Now, CarWow try to direct the nearest dealerships and the ones who offer the best service to the customer to give the quotes. Unfortunately, because they haven't got full complement of dealer support nationally, what tends to happen is it's still a dealer from out of territory that puts a ridiculous discount. So it's, unfortunately, you know, we're partly to blame as dealers, but it's become a race to the bottom.
Do you use CarWow? Do you work with them?
In a very limited way to test it, but I have to say that we're likely to be pulling away from it because it's just becoming a race to the bottom. And that's fine if you're pumping out a few cars out of your territory just to try and help hit a target, but it can't be the sustainable basis for a business model. If that became the 80 rather than the 20, we'd all go out of business. So unless something fundamentally changes about a business model like CarWow, then I don't think it's going to get the traction that they would ultimately want from it.
Another question from Auto123 says, can you ever see a model like Tesla's where people can buy straight offline is going to become a reality?
No.
No, definitely not.
No,
So,
I think particularly for something like Tesla, where electric technology in cars has taken off slower than we all thought. I mean, 6-7 years ago, I drove a Nissan Leaf for 6 months and really enjoyed it. And I was convinced that electric cars would take off much more rapidly than they have done. But they haven't. The range isn't big enough. People are worried about the safety implications as well as the range, and what does the residual value of an electric car look like. There's a lot of risk involved. So I would say it's less likely that you're going to buy something like that over the internet. Don't get me wrong, there are a small proportion of very enlightened, technically competent people who will do all the research and feel comfortable doing it, but that's not where the market's at. And there are people who are willing to take a chance on buying a car that they haven't seen, from a long distance and have it transported to home. But generally, it's a physical used car. They've seen not just photographs, but a bit of video, probably a personalised bit of video through something like See It Now, which we use across the group. So they're pretty comfortable by that point. They've had quite a lot of human contact.
yeah.
I mean, even Rockart, I understand, who are the forerunners of developing a model where you can buy over the internet. I was given a statistic from a very reliable source that says that something like 95% of their purchases are completed in the store.
Yeah.
They're not done over online.
I was going to say, that's a really good point, because even people who would look at all the photos and they've done some emailing, there's still a human contact there rather than just filling out a form, which is what makes a sale at the end of the day. Yeah,
so there's two things you're asking about there really. One is electric cars, which I do think will continue, but at a slow pace until the range catches up with fuel engines, and buying online. And my own view about buying online is that, particularly in a world where so many customers take it on PCP, the renewal process through PCP could lend itself to online activity quite well.
Right, why is that?
Well, so typically what would happen now is that dealers will ring a customer, let's say 27 months into a 36-month contract. We have software that tracks whether they're in parity or equity with that current agreement. And we will ring them and say, great news, just bring your car down. You can have another one with the panoramic sunroof and the bigger wheels, the uprated sound system, and the payment's going to stay the same.
Wow.
And the customers, in a lot of cases just say, okay.
Yeah. I'll take the new car.
You can see how
you swap the cars over for me, please.
Yeah, well, that's it. And you can see how that could take place on the internet quite easily.
Yeah.
Yes, I'll have it, or upgrade, that's £10 a month more, pick a date, swap over.
Yeah,
you
makes a lot
could
of sense.
see how that could, and when such a big proportion is on PCP, that could be part of the challenge.
I'm really sorry, but we're going to have to say thank you very much for coming in. That's been really interesting, and I could probably talk to you all day about that. Thank you all for watching. Hopefully you're all still with us. We'll be back again in 2 weeks' time with Ken Savage from Perry's, so get your questions in, start emailing them over. You can email info@tradeplates.tv, or you can tweet @tradeplates.tv, or get on the car dealer forum. We'll be picking loads of topics off there as well. Thank you very much for watching. Thank you, Nigel. Thank you, James, for joining. It's been really good. And we'll see you again soon. Bye.